the secret sauce for anyone who's created wealth. And what compounding is while you continue to work, while you continue to grow your career, I can put this money to work for me. So while I'm sleeping, my money is working for me, and my money is continuing to grow and compounding in a non-correlated asset.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe.
Mike, I so appreciate having you here. I'm super excited to be partnering with you and Aspen Funds on the topic that we're going to be getting into today. We've got some really great things, not only in private credit, but deep dive into investor relations. And, you're such a great person to be talking about both of these. And so before we get into those topics, tell us a little about, yourself and Aspen Funds.
Yeah, you bet. Well, thanks for having me first and foremost, Stephen. Appreciate you and getting to spend some time in Phoenix. Got to soak up some sun. I'm here in Kansas City where Aspen Funds is based. So I'm a Midwest guy, born and bred, and I have been here with Aspen for a little while. My role kind of specifically heads up capital development and kind of our investor relations team. And so really what that really means is I'm capital focused. So I bring in capital from capital partners. I bring it in from, we've got a large retail investor base. And so really my background has been in real estate pretty much my whole career, really more on the investment side. First half of my career was kind of corporate level property management, large national type groups, and then pivoted into investing myself and more to the small business side. And that's kind of transformed into running investments, syndicating assets, and fast forward to today, I've been with Aspen here for 3 years or so, and I've found kind of the perfect marriage of my skill set, my background, and the things I'm passionate about, and love working with investors and creating financial freedom for those that are their eyes are getting open to the world of alternatives, and so I've been doing it for a long time, and I know it very well, and yeah, so that's, in a nutshell, that's me and what I'm doing here. A little bit about me personally. I'm married. I've got my beautiful wife of almost 15 years now in May. So
Wow,
she's,
congrats.
thank you. Yeah, it's been a wonderful journey. I've got three young girls, 8, 6, and 2, which take up the majority of my free time. But when I'm not with my family, I'm definitely talking real estate, talking, passive investments with, people of all walks of life. So.
Yeah. And sounds like you got your priorities right there too with the family keeping you busy.
Yeah.
I think that's really cool to talk about your background too and how you found your way into Aspen with your background of real estate and investing, because, a place like funds and alternative investing and alts is that it's like the best way to reach a lot of people and to also scale the investment so people can take part of those investments too, right?
1,000%.
Yeah. And, Aspen has one of the things that was really cool to see is your guys' track record. And I love to, see yourself and, Ben Fraser, your CIO, talk about how, the pride in giving back dividends and returns as well, right?
Yeah, for sure. Yeah. So we've been at it for, 12 years now, and, multi-asset firm. So what we look at really is macroeconomics first, and then that kind of distills down into where are these inefficiencies in the market? What are, assets that are benefiting from these trends? And so that when you look at Aspen, you see diversification across these different verticals, and all that ultimately is kind of tied to timing. Key timing ultimately can create kind of outsized returns and or consistent returns for our investors, and that's what we've kind of been known for, is just super steady, kind of as mitigate as much risk as possible, but obviously have to calculate risk when making investments. So kind of, the genesis of Aspen has been investing in, mortgage notes, buying distressed mortgages for over a decade from banks and hedge funds, and all sorts of places that have performed very well through the years, and our investors have been getting checks from us every single month for over a decade. So that's
That's
really where
so
the
cool.
track record began, and then it's over time evolved into these other asset classes where we can get into some real estate developments and value add, and now we do things in oil and gas and all sorts of different asset classes. So they each have a place in constructing really a portfolio, and we love it. We're super excited about everything that's happening, and blessed to have success kind of behind us to build a firm foundation on.
Yeah, and I'm glad now you mentioned two things, right? The getting checks out to investors every month. Um, that is so awesome to hear, as well as the different asset classes. But the thing that impressed me, I mean, I can't say the most, but along with that too, was to see emphasis on data that you guys look at in-house, right? And so that global and the macroeconomic trends really helped you to find not only those different assets you talked about, but what we're going to be talking about today too.
Yeah, well, I'm excited. Let's
Yeah,
dive
man.
in.
So let's dive in. So I'm really excited. We're going to be talking about some private credit. So talk to me about, what is private credit?
Yeah. So private credit is a pretty broad, a pretty broad term in a broad sector. So private credit ultimately is private lending in a sense. So this could cover, things like commercial real estate assets. It could cover things like small businesses, large businesses. I mean, businesses and real estate. Really, those a piece of real estate, particularly commercial real estate, is a business in itself.
Mhm.
It's a small business that has a very specific set of levers to them, whereas a small business that's selling goods, services, et cetera, those businesses need funding and they need capital on a consistent basis. So private credit broadly is lending in preferred positions to those particular businesses. So that's kind of like that's the really big picture. So you could do a lot of different things in that. Kind of specifically what our side of private credit is focused on is more the real estate assets on the commercial side. More specifically, a few key assets like multifamily, apartment complexes, and industrial buildings, maybe some smaller neighborhood retail type of strip centers. You've got some niche type of assets that are really underserved and don't have access to much needed capital.
Mm-hmm.
And so what private capital is doing is we're not a bank, and so we have flexibility to create terms that fit the business so that the business can be successful, and ultimately the investor, being us, gets to mitigate some risk while also getting acceptable rates of return.
Yeah, and I'm glad you mentioned the bank as well, because as you're talking about that and it's like lending, someone might be listening to this and thinking, well, that's kind of like what a bank does, right? So why would someone come to us, Aspen, for private funds versus the bank?
Yeah, well, I think it's both and. It's not an either or. There's a lot of nuance, particularly when you get into commercial real estate. There's a lot of nuance when it comes to lending, and so there's a whole slew of reasons. Some of those are particularly right now. What we're seeing in the marketplace is a tightening of bank credit. So what that would mean is where they might have lent 80% of a purchase price previously, now that's been squeezed to 60%. And so you have, as an operator, Stephen, say you're buying an asset, and where you used to be able to get an 80% loan to value, now you're getting 60, but I still have the capital need to go, finish the business plan for this property. I need to go do improvements. So I need working capital. And either you can go raise that from your investor base, which you'll do, but another way is to also piece in some of these positions and build out what we call the capital stack. So the capital stack is, in order of priority, the positions in that asset. So you generally might have a senior loan, so maybe 60% of the purchase. Then you bring in what we call either mezzanine or pref equity. So these would be positions that sit behind the senior, but ahead of all of the common equity. And so why somebody might do that is, one, the bank's already lended what they're willing to lend. Second, other banks are not lending in second position. They will a regional bank, an agency lender is not going to take a second position. It does not happen. And so that creates this opportunity for private capital to kind of bridge that and fill out the capital stack, while ultimately, when you're in a piece of real estate that's adding a lot of value over, say, a short period of time, relative short period of time, 3 to 5 years, say, we can cap the returns of that private capital that's coming in. So the interest, the return is set. And so they're taking a lower return. They're taking priority in terms of payment over, the common equity. But if that business plan is successful, all that return is what we call accretive to the other investors. So you can make your investors can make more by bringing in private capital to kind of fill the capital stack. So that's, in a nutshell, that's kind of why somebody would do that.
Yeah. So based on that, does that mean that someone might look at something like, considering this capital stack you're talking about, and how we have the senior debt, right, at the very the bottom from like a bank or so, and then you have what would be like private capital, private credit right on top of that, as an example. Does that mean that it's more risky, or what's the perception on that?
Yeah. So you're taking less risk than the common equity. You're taking, of course, more risk than the bank because you're in second position. But it really comes down to underwriting. You can mitigate a lot of risk through the way you underwrite. You can mitigate risk through the way that you structure your position. So inherently, it is more risky because you are not the bank, and the bank is going to take a much lower rate of return. But that's all that they want, is like, I just want to make sure that I'm whole. And so that's why we're seeing that, banks compress those lending limits, right? Is because they are unwilling to take on more risk in an environment where interest rates are higher, in particular, that can affect valuations of assets. So that's kind of squeezes that. So it would allow somebody like us to come in and evaluate an asset as it's transacting, look at where the lending is with the senior, and basically do a calculus. Do we have enough equity cover in this asset to cover our interest in the senior? Ultimately, I don't necessarily I'm a lender, right? So I don't necessarily need to care about the common equity, although we do. We want it to be successful. You don't necessarily need to care about that. So we can really look at an asset, and we can look at its underwriting and say, we don't need to be as optimistic about this, and this. Maybe that's a pretty realistic outcome, but we can really stress test this property and this underwriting and say, hey, what happens if interest rates do this? What happens if cap rates, go up? And what happens, when you pull all of those levers and you stress test, and at the end of that, you're like, hey, the most likely scenario is that we're going to not only cover our interest, but the GPs and their investors are going to be profitable. This is a good asset for us to be in. And right now, like, if you really look at it from a risk-adjusted perspective, the number one is private lending, private credit being kind of a part of that. That's why you're seeing, BlackRock, all of the massive, private equity firms out there are doing exactly this, because it is the number one risk-adjusted return there is in the marketplace.
Yeah, that's awesome. So this technically takes the place of mezzanine or preferred equity. Is that basically the areas where it plays?
Generally, you can also, private credit, you can do what's called bridge lending. So bridge lending is in a first position. So our fund will have a combination. Generally, where you have bridge is where, you have an asset that maybe it doesn't qualify to go get an agency loan from, Fannie Mae or Freddie. Like, they're doing some type of deep value add, and the occupancies are too low at which they can go and get a bank loan. And so bridge loans come in to help, that business plan, but it sits in first position. So we'll have a combination, but I would say, 75% of our fund is going to be in this kind of mezzanine pref equity position.
Cool. And like you said, that it's based off of the underwriting or the analysis of, income and expenses for it effectively.
Exactly.
So we have enough cushion there, right?
That's exactly it.
That's awesome, and I really appreciate breaking that down too. So, when it comes to the different types of asset classes, you're talking about right now, like a Fannie or Freddie. So you're talking about specifically multifamily, right? Apartments. And so, is that what we're looking at doing private credit on most, or what
Yeah.
other assets are in the private credit fund?
Yeah. So we do, our heaviest allocation is going to be multifamily. It is and will be. Um, we like the underlying economics. So when we talk about macroeconomics, part of looking at that is what are the underlying supply and demand, considerations for an asset type.
Mhm.
So what we see here in the US in particular is still an undersupply of housing. And so while multifamily has definitely gone through some bumps in the road here this last couple of years, what we are seeing is a still an imbalance in supply and demand. So from a longer term perspective, we feel that multifamily they don't have an economic issue from that perspective. The challenges that they've had have been more the basis, the competition that's driven up prices and people have overpaid for those assets. The underlying asset and looking at the underlying economics of that is another way for us to kind of de-risk or manage risk in the fund. So if we are over allocated to a certain asset class that doesn't have very good underlying economics from a supply or demand perspective, then that's adding risk potentially unnecessarily to the fund. And that's why multifamily is going to be kind of the anchor allocation for this fund,
Hmm.
with then layering in some other assets like industrial. There's a really strong thesis for industrial, and we operate a lot of assets in industrial ourselves. Neighborhood retail is a unique one where there's not very much inventory, and they haven't been building it for years. So there's just kind of specific assets that are going to have those economics that we'll continually allocate to.
Cool. So basically, what you're saying is, from the assets that are in the fund perspective, that multifamily and is such an anchor asset because it's been really stable in a lot of ways, that it is going to be the foundation and kind of core asset for that fund. So you always make sure that we have it producing great returns right away before we
That's
bring
right.
in other assets.
That's right. Absolutely.
Okay, cool. So what are some of the other, I mean, is there any asset class that you can't do this with? We can't do lending on, or, do private credit with?
So I mean, we're focused on real estate assets, so we're not going to be doing business lines of credit and those type of things. So it's a little bit different underwriting, different considerations. So we'll be focused on real estate assets. Within real estate, we haven't limited the fund in that sense because this is a long-term fund. This is designed to be what we call evergreen, so where it's
Hmm.
operating far into the future. So trends change. So along those lines, we don't want to hamstring it. With that said, that's really where we come in with our management expertise to be able to kind of look at the macro landscape and decide, are the tides shifting on office, for example? Office is something right now we wouldn't touch. There's maybe a few nuanced asset classes like medical office is actually really great, but just general office across the nation has struggled.
Yeah.
And yeah, so that's not something we're going to lend on right now. Generally, we'll steer clear of hospitality. It's a different animal. Because the other piece of this is, part of the downside protection is we have to be prepared to take an asset over and operate it. And so we got to be able to, functionally do that. We're really set up well to do that with multifamily, industrial, retail, some of these other nuanced asset classes where we got proximity and property management and those type of things that we can plug in and control the asset. That's one of the biggest considerations for us. So things like hospitality is just a totally different animal. The management effort is totally different. So we won't be doing much of that. Actually, we won't be doing any of that at all, at least in this phase of the fund's life. Yeah, it will depend, but generally it's going to be kind of those four core type of assets, which would be heavy multifamily layered in with industrial, neighborhood retail, and then some kind of nuanced retail, maybe some residential type build to rent type communities, those type of assets.
Awesome. Okay, that makes sense. Talk to me about what you a little more about what you said there. Of there might be an event where we would have to take it over and have to operate it. So
Yeah.
you guys have experience doing asset management, right? In some
Oh
of
yeah.
these other asset classes, which is why you say that. And of course, if you're doing a lending, then I mean, things can happen. That's on a risk adjusted basis, but things can happen where you might have to step into operate that or manage that asset as well. So talk to me,
Yeah.
in the case something goes awry, something goes negatively, where you've lended on an asset, it doesn't go as well as we hoped for or could or analyzed, and then you have to step in. So what safeguards are there in the lending for that asset for us to
Yeah.
step in and take it over, and then what kind of happens from there?
Yeah, you bet. Great question. So, I would say first and foremost, a bank does not want to take assets over. That's why they foreclose and they sell at a discount. I just need to cover my interest and get it out the door. So the
Yeah.
bank does not want to hold foreclosures, like number one. So banks actually love having people like us in the capital stack because we can step in. So it depends on, it depends on the position type, right? So you have bridge loans, you have mezzanine debt, and you have pref equity. So each of those have slightly different levers. A bridge loan is very straightforward. You have foreclosure right. You're the only lien position. You're the senior loan. So that's pretty straightforward. You can foreclose and do
Hmm.
as you please with the property. Mezzanine is a lien. It's a lien on the interest in the company that holds the asset. So you have asset 123 Main Street that has the first position lien on it. Then you have 123 manager entity that holds the asset and operates the asset. So mezzanine is basically a lien on the interest that operates the asset. So you would, basically, foreclose on that and take control of the entity that owns the asset, which would then give you control to dictate how the asset's handled.
Sure. Effective,
Um,
functionally the same though.
Functionally the same, just different positions.
Yeah.
But you still have the right, so if
Right.
they default, it basically is an event of default, whether that's payment or violating terms, things like that. So you have a term sheet that lines out exactly what the agreement is. And then preferred equity is very similar to mezzanine debt, but it's technically not a loan. So preferred equity is technically equity. And what we layer in is at a baseline, we have what's called a forced sale right. So forced sale would be if you're in default of those terms, whether through payment or term, we can drag the market to property and force the sale of the asset. So we get added to the operating agreement for this company that owns the asset. We get added to that gives us the right to do that. And so that's one of your levers. Additionally, depending on the type of asset and what's able to be negotiated, we might have what's called takeover rights. So, 123 manager has a manager, we can step in and take over that management and then operate the asset. And so that's a way for us to de-risk, is really cover our interest and ultimately the bank's interest, because if they're sitting in first position, they get paid first. So we would step in a situation like that and either drag it to market. If there's enough equity cover, you just drag it to market and force the sale, or you could take over management and operate it yourself, because you may not have an issue of the underlying asset may not be the issue. It may just be mismanaged. And so that's where you need somebody with skill and expertise who actually owns and operates assets, which we do in
Hmm.
our other real estate holdings. We manage our own assets. So we're able to step in and do that. And that's a huge consideration with this type of lending is the operator an operator, and can
Right.
they step in and take it over and have the expertise to do that. So we're fortunate that we do. And that's why we kind of have these curated asset types, because those are the ones we're really set up well to do. That's another way for us to de-risk the fund.
Absolutely. The education and experience to do it, and the amount of track record for doing that too. So what's the, two key points on that, the force to sale and also the takeover rights. Um, do you have is it pretty case by case on which option is the better route? Or is there,
Yeah.
you lean to one or the other as a default?
Yeah. I mean, at a default with pref equity, we're gonna require a forced sale right. So that would be kind of a baseline. If you can layer in takeover, then that's an added bonus.
And it's a bonus. For what reason?
Again, you may not have an issue with the asset, and or maybe the business plan hasn't been, fully achieved, and it needs to be achieved, and it just needs a new body in there, a new manager. So that takeover right is an added bonus where we don't necessarily need to drag it to market, or maybe it's not as beneficial to drag it to market because we really want to add more value through, the business plan, and
Right.
we just need somebody who can execute the business plan. So that takeover right is kind of an added bonus to where, yeah, we maybe could cover our interest, but we could actually make more and or more effectively cover our interest by taking the asset over. So that's the difference.
Yeah, advantageous if you can take it over and you can execute the rest of the business plan, whether
Exactly.
that's additional parking lots or laundry or whatever,
Yep.
to raise the effective rents and to decrease any expenses and go from there.
That's
Um,
right.
and then just to cap that part off, the reasons why we would want to drag it to or get into a position where we'd drag it to market is if it was mismanaged. Or what are some of the other reasons why that might be that trigger that force to sell?
Yeah. So you have in your term sheet is basically it's your document, it's your agreement, and effectively it's your loan documents. And so that term sheet is going to line by line outline the expectations and the requirements. And so say, one would be they didn't pay, so they didn't pay the preferred return that we were supposed to be getting. So that's an obvious.
Mm-hmm.
Pay the bank, they're going to take the asset, right?
Yep.
So that's the obvious. Other things would be like, hey, they violated certain covenant requirements where their DSCR, debt service coverage ratio, dropped below a certain level, or they didn't execute on a business plan timeline where, hey, you needed to have renovated and added X amount of value by X amount of time, and that needs to be reflected in the effective rents that we're achieving on the property, things like that. So if we're seeing that those are misaligned or they're not hitting those benchmarks in the term sheet, that's a situation where we would step in.
Cool.
There's kind of a scale, of the severity, right?
Yeah.
How severe are we in that situation?
Yeah, absolutely. And I love what you were saying too, Mike, about in a case like this, banks don't want to be. They're not in the real estate business. They're in the lending business. They're in the business of having other people take care of those assets and them getting checks in the mail, right?
Exactly.
So like you said, it's really advantageous for Aspen and you and your team to be there. Will you negotiate with banks and keep communication with them on part of this process as well?
Oh yeah. I mean, you have to get approved by the senior. So in order to have, a second position, get added to the operating agreement, the lender has to sign off on that. So it's part of an operating agreement. You have governing documents. It's very legally enforceable. And so the bank has to be fully in line. And so we know all parties and all are in communication.
Awesome. So it makes a lot of sense right now to be, and be in this business of lending and specifically multifamily, because looking at the macroeconomics, multifamily still makes a lot of sense. And because banks aren't lending as much as they used to, it creates this gap, this opportunity in the marketplace to come in and find these assets, these apartments to step in and get returns for investors.
That's exactly it.
Cool, man. Well, I think it's such a no brainer when you just say it in a couple of lines, right? Just like, well, there's this opportunity. Well, if we fill it, we see it's going to be there for a while. This is what we do,
Exactly.
Um,
If
and
only it
so,
was that simple, right?
yeah, absolutely. It's simple, not easy. Simple, not easy.
That's a great way to say it. A great
Um,
way to say it.
but I also want to talk about investor relations. I think this is a thing where you talk to some investors that have, invested in syndications or wherever, and they're like, well, I hadn't got a report or, in a month, a quarter, 2 quarters, everything's been silent, and so I really want to shed some light on this for the listeners to, hear from you and on what investor relations is, to talk about what is good investor relations look like, and
Yeah.
what to expect before the investment, and as well like what to expect along, after investment as well. So, for anyone who hasn't been heard about investor relations yet, like what does that even mean? Help us demystify this.
Right. Yeah. So investor relations covers, a handful of things. So it's generally, it's the relationship with an investor who is your client. So, I mean, it's not overly complex for anybody who's been in any type of, service related position, understands that your clients are, that is, that is your number one. Right. And
Mhm.
so investor relations looks like, not only prospecting and starting a relationship, but it's also kind of seeing that relationship through what we call kind of fulfillment of an investment, and the ongoing execution and communication of that investment. So investor relations really takes it from start to, into perpetuity. That relationship, effectively with some of our investors have been with us since the very beginning, 12 years and counting. So this role is very, very important for fostering the relationship, and it's understanding what are your clients' needs, and then simultaneously what are the company's offerings, what are the strategies that we can, provide value to our customers. And so that investor relations kind of synergizes, between investor needs and the company, the organization's opportunities, really. So that's kind of on the front end, and then on an ongoing basis is the consistent communication of keeping your investors abreast of what's going on, and performance, and everything that goes into, hey, is my money doing what it should be
Right.
doing, and do I have clarity on that? Uh, so that's a lot of the day to day that's involved in investor relations. So yeah, in a nutshell, that's that's basically what investor relation does.
Yeah, it's making sure that the people that you're whoever's offering some kind of investment, offering, like you said, any really service-based business, it's the people that you like that you do business with, whether it's even in restaurants, if you have a place that you love to go back, they're, they're sending you things as well. They're like, yeah, come back, try our chicken this time, try whatever we have for you, right?
Exactly.
And so
Exactly.
building that trust too. So um for someone that's listening, if they haven't invested yet, they're looking at, okay, cool. So we have this private credit fund, makes a ton of sense. And, I'm looking to, um, invest. What does that process to invest even look like?
Yeah. Well, any good investor relations team has a process, right? Within the process is kind of clarity, is freedom to, engage in the relationship, because we've got a process to actually fulfill whatever's needed. So, generally all of the things that we do here at Aspen are exclusive for accredited investors. So kind of first and foremost is the validation of that accredited status. So for those of you that are not familiar with it, potentially, it's an SEC required designation, which is basically a wealth figure. Do you have $1 million net worth, and or is your income, 200, in excess of 200 for the last 2 years, and kind of continuing if you're single, 300 if you're married. There's some other scenarios where you can be accredited, but most often it's kind of those two scenarios. So the process is getting that validated by some type of third party that can sign off, CPA, a CFP, attorney, somebody who can say, I've looked at this person's personal finances and said, yes, you are accredited. So that's kind of step one to be able to qualify. And then in doing so, we'll then qualify you to go and actually, review what's called a PPM, so a private placement memorandum. So that's basically the offering spelled out in full, legalese. This is,
Yeah.
here's the investment, here's exactly what it's doing, here's the stated returns, here's the stated intent, here are the risks, here's the business plan. It's laid out in, a not so short document.
Yeah, that's for
And
sure.
so it's really important to, for one, to make sure there is a PPM. If you don't have a PPM, then you don't have a legal compliant offering in for investors to participate in. So for those out there, if they're going to be investing and somebody says, "Oh, I don't have a PPM," and that's an immediate cue to run. So
Yeah.
that'd be kind of number one, and then that'd be kind of second step in the process is kind of reviewing those documents, those offering documents, and then you're subscribing. You're signing up to those documents, and it's not overly complex. After that, you're cutting a check and you're vesting into that entity that is that's making the investment. So you're taking a share of ownership. That's effectively what you're doing, is you're becoming an owner in this entity that is investing in these assets.
Hmm.
And so it's not overly complicated. There's certainly nuances behind the scenes, but generally it's not overly complex. And so the things that kind of separate good and bad is really how easy is that, how transparent is that. Do you have a point of contact who's a real person that can communicate with you, explain questions, because this is the nuances in there are that there's a lot of legal language, and trying to understand this for the first time for folks that are new to it can be challenging. And so having somebody who can be a resource and a guide to answer those things accurately and ensure that you have a full understanding of what you're investing in.
Yeah. Great point too on, a real point of contact who's a person and someone you can ask questions to, because there's so much of this that is education along the way too, right? I mean, any first time investors is like multifamily, and then you say apartments and you're like, oh, okay, got it. Let alone everything else too. And so you said a key word there, which was transparency. So, make sure they're accredited, make sure they go through this process to read the PPM, look at the PPM, and then, of course, go ahead, subscribe, wire funds to wherever it needs to go. And from there, you said transparency. So what is that? What does that look like after the investment is made?
Yeah.
Especially from that
So,
transparency perspective.
yeah, I mean, I think number one, transparency is also setting expectations, clear and understandable expectations that are reasonable is kind of the first step in a transparent relationship, which is, hey, Stephen, you're going to invest with me. I'll talk to you when I talk to you, is not being transparent. So being able to say, hey, Stephen, we've got you funded here. We're so excited to have you along board. Here's what you can expect moving forward from a reporting perspective. I've activated your portal, your investor portal, where you have visibility on your investment. The documents that you've signed are all available there. You can review those at any time. So having a process, but also being able to clearly communicate those expectations, and then say, hey, on an ongoing basis, all of our assets, we report on this schedule. So whether that's quarterly, some people do it monthly, some people do it, multiple, 2 times a year.
Yeah.
As long as it's stated and understood and it's reasonable and agreeable, it's whatever you're comfortable with. I would say the expectation generally is quarterly with these types of assets. So that's what I'd say to you. Yeah, Stephen, we're on a quarterly schedule, and you're going to get your reports. You're going to have full financials on the fund, as well as your own personal statement, and then kind of a letter that interprets all this for you about 10 days post quarter close. And you can expect that like clockwork. And if it hasn't happened, you absolutely call me directly, and we'll make sure you have whatever you need. So that's the type of transparency that needs to happen right out of the gate. And then, beyond that is also what is actually being communicated. It's not okay to just set an expectation and kind of partially deliver on that. It's a whole nother level to actually say, here is the level of reporting and transparency that you have in the asset that you're investing in. Here's how good of an explanation that how clear of an explanation we can provide you as to the performance of the asset and what is going on with my investment. Mm-hmm. And so that's what separates really, people who are mediocre, shall we say, and those that are best in class. The best in class are the people that are publishing audited financials or unaudited in between audits. They're publishing unaudited financials. They're giving you, full description of what's happening at the fund level. They're giving you full transparency of your account, the distributions that happened within your account. and then being available for questions. Like that's the level that should be, that's the expectation. That should be the expectation from Aspen's perspective. Is without that, we're really, we're if we didn't do that, we would definitely be in this mediocre category of, we provided enough reporting to say that we did it, but not enough to actually make it clear as to what the performance is.
Yes, 100%. And the make it clear point, and also point out, know your audience, right? Always know your audience. Golden rule. I mean, so many golden rules, but a very important rule being, if you have someone, whether it's they're more experienced or less experienced, it's kind of like, you still have to, you can give a bunch of information, but you want to highlight certain things. Think about, what is your customer, your investor most interested in, right? What are the frequently asked questions? Put those up so that I don't have to parse all this stuff. What do I need to know right now? Is the executive summary of it, and FAQs,
Yes,
so to speak, and then kind of go from there too, right?
absolutely.
Yeah. Okay, awesome. I absolutely love that. Is there? I got to put this out there because we can talk about what good looks like, but we also, like you were talking about, if there's no PPM, you have to run for the hills. That's just the way it is. And so, talk about some of those other things that first time, second time investors can be, looking for. Of ooh,
Red
so and so
flags.
did, yes, red flags to be looking for. Of, well, maybe I should stop and do a gut check here.
Yeah, for sure. I mean, I think, one, if you're an accredited investor, you're obviously an intelligent person generally. Like this is, use your intelligence, like use your instincts to, you know, look at the situation and not just assume the best about what somebody says,
Mhm.
and look to their track record. 100% is a place to start. That's a place where it's much harder to hide when somebody says, "Yeah, great, this all sounds great. I would love to see your track record." How somebody responds to that question is going to be pretty telling. If somebody has a track record, is going to be pretty telling. So I think track record is paramount in this industry. And for those that are starting out, that's okay. You don't necessarily have to have a deep track record, but the way that they answer that question and how honest and transparent they may be is going to tell you some things. So definitely question that. First and foremost, I would say look for people that are willing to volunteer information. So if you said, "Hey, do you guys do background checks and things like that on your key principals in your company?" The way somebody responds to that is going to be pretty telling. So there's some key questions that you, investors can be savvy enough and have enough interpersonal skills / life skills to be able to you know try and filter through somebody who might be trying to sell you snake oil.
Mhm.
And there are people in that industry that do, in every industry really, but there's definitely bad actors out there. So it's really important to take your time. Um, Again, like we talked about, an obvious is PPM. The other is just their presentation in general. Um, it's not to say that somebody who's not a marketing expert is inherently trying to swindle you, but certainly if somebody lacks the business sense to have something that's well organized and clear, those would be cause for question at a minimum. So start to piece together a picture of what is it that their presence says they are online, in their background, in their track record. What do other investors say about them? Do they have reviews on Google? Like the natural things that you do when you're looking for the latest Thai restaurant you're trying to try out. It's like
Yeah.
it's not rocket science in that sense. It's like, what do other people say? And the SEC, these are all these investments are governed by the SEC. So if there's SEC filings, there's lawsuits, like that stuff's public record. You can find this information. But the alternative investor community is also not so huge. Like it can be a little bit of a small world of people who've really like opened their eyes to this world. And there's online forums out there. If you do just a little bit of digging, you're pretty much going to figure out if somebody has performed or not. And if somebody's newer to the game, that's where you just take your time and spend more time getting to know them, spend more time, trying to get to a place of transparency and understanding. Is this somebody that I can trust? And yeah, those would just be a couple of nuggets that I'd say will be tactical things to help.
Yeah, those are good ones. I think especially on the key point of, how organized is someone? How do they present themselves? How is their presence? Like you said, um, that that how you do anything is how you do everything type of thing. Of
Absolutely.
how much do you pay attention to your surroundings, and
A
how do you
thousand
show up,
percent.
right?
Exactly.
Um, I'd say one sort of question here too before we're kind of quick section before we bounce here is, um, I'm curious like what your take on this is, because I network a lot and I'm talking to a lot in the company that I work in. No secret, I work for Amazon, and I like to work and talk to as many people as I possibly can and connect with the real estate there, because they know scale of company size, of whatever they're working on, for customers. And a lot of them are really talented at what they do, right? But at the same time, they're thinking, okay, hey, Steven, real estate, like, do I do like a long-term rental? Should I do like an Airbnb or something? And I'm like, well, you can do these, invest in as a passive investor. So what I'm want to tee up for you as a question here is, um, why is it so powerful to work with someone that is an operator or has funds that acquires real estate, and have this person in tech that continue to focus on their bread and butter of tech?
Yeah. Well, I think it's a great question, and it's one that I think is anybody who's ever considered alts who's getting started in alts is like, this is the confrontation of everyone's life. Is like, man, I am in the rat race effectively, and you may love your job, and that's wonderful, but are you really creating wealth? And so wealth creation can happen in a lot of different ways. But what we find, particularly in private alternatives, is that you have returns that are what we call non-correlated returns. So a lot of people have been coached into the stock market and bonds and all of these kind of publicly available, most accessible, efficient markets that they can access with ease. And they've been putting their money into their 401k, and their company is matched, and they just continue to let their financial advisor or whomever just manage that kind of blindly. So part of the world of alternatives is kind of confronting yourself with the reality of taking control, and that there actually are better ways, and there are people that are compounding their returns at a much faster rate and creating financial freedom for themselves in ways they didn't even think possible. And so I would say this is the industry is somewhat new in terms of its accessibility. So 2012 was a very critical moment and a shift in the world of private alternatives. Historically, this has been dominated by the ultra wealthy, and they still do this. So we have a podcast called Invest Like a Billionaire. How much do you think billionaires invest into alternatives? Somewhere upwards of 30% of their portfolio is in private alternatives. And the reason is because you have what's called non-correlated returns. So these are, in the public markets, you can see returns kind of in a given asset. Maybe you have diversification across different stocks and bonds, but when something happens in that market, we see if they both go down at the same time, not good,
They're
right? So
correlated.
having non-correlated returns is, I can maybe, real estate, for example, when the stock market goes down, sometimes it goes up,
Mhm.
so there's a important principle, at a baseline for everyone to understand. Diversification in a stock portfolio does not necessarily mean that you're diversified. Being in a REIT is still publicly traded, and REITs can go down. That those are real estate, but you're not actually buying the asset. You're buying, stock in a publicly traded REIT. So it is very, very powerful to understand what actual diversification means. And I think alongside of that, like if we're specifically talking private credit, is the power of compounding. Compounding is the secret sauce for anyone who's created wealth. And what compounding is while you continue to work, while you continue to grow your career, I can put this money to work for me. So while I'm sleeping, my money is working for me, and my money is continuing to grow and compounding in a non-correlated asset. And so that diversification is critical, and things like private credit. That's why it's so attractive. And it doesn't sound super sexy in a sense of like, oh, you guys are just lending to apartment complexes. Like when you actually look at the power of that, and you'll have a bunch of resources. We have a bunch of resources surrounding this, but you really think about building a portfolio of investments like a pyramid. And so that pyramid is the base of that pyramid is kind of the low slope. The lowest part of the slope is risk. The high part is the high risk. So the slopes are risk. But then the shape, the triangle of the pyramid is volume of investments. And so as you move up the slope, you need fewer and fewer investments that are, hyper risky or very risky. You need a solid base of consistent compounding assets that provide you consistent cash flow and or convertibility of cash flow, where you don't necessarily need cash flow today, but I'm going to need it when I retire in 10 years or whenever that is. So that's the power of alternatives, and that's the confrontation that I think every investor has to have with themselves: is, am I going to take control of this, or am I just going to entrust it to the public market for this to go up, 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 and then maybe we get a big drop down. You may have had a really nice run in the stock market, but you have way more volatility, and if they all drop at the same time, you're a lot less diversified than you think you are.
Yeah, and so many nuggets out of that, but especially the part of compounding too. I don't know, I forget Ben Franklin's exact phrasing around that, but he calls that a wonder of the world, compounding. But
It
also how stock market will go up and down, and they'll say on average it increases a certain percentage, but that's different than compounded over time, right?
Absolutely.
And
If
so
you looked at, say, 30 years, compare side by side, say you said I had 11%, 11% compounded over 30 years. I started with $100,000 and I just continually compound that. Then I look at that with maybe, I'm up 20%, I'm up 30% this year, I'm up 20, but then I drop even just a few times, say maybe 4 or 5 times over the course of those 30 years that you drop, you have a 20% just reduction, not even a loss of capital, just a reduction. You would look at you'd be profitable in those 30 years, and you'd start with 100. Maybe you'd have $500,000-$600,000 over the course of that time. If you were compounding at 11% over those 30 years, you're going to have $2.5 million.
Yeah.
So there's a massive delta, and that's the power of compounding, is just consistency and the ability for that just to continue to grow, and it's not correlated to these big drops. And that's the beauty of building that base of that pyramid is assets like that.
Yeah, I'm going to take that pyramid concept. I appreciate it. That's one I'll be drawing a lot. So, man, is there anything else that you wanted to mention about this? I mean, we covered so much about private credit. Again, just what it is, how we fit in the gap that Aspen fills for not only for the GPs, the people that have acquired those to begin with, but for the investors that trusted them the first time around too, as well as the investors for Aspen. So, and then what great, investor relations looks like, a lot of education for a real point of contact, someone to talk to, and gets extra attention as well, especially the entire way through. And then, when the investment is made, to continue to have that transparency, to continue to get great communications tailored to, what's going on with this asset, the good, the bad, and the ugly, and to, be clear about that up front. Anything else?
Yeah. No, I mean, everyone needs to be best friends with Steven. That's the thing. It's like you've already you've seen the writing on the wall here, and this is this is the power of having people trusted, trusted uh, partners, really, to have a financial partner like somebody like you that's doing the work and doing the due diligence to really weed through, who are the bad actors out there and how do we stay away from them, and who are the ones that can stand apart, and how do we align interests there. And so I would say, yeah, everybody who's talking to you needs to talk to you a lot more and become best friends, because you've got access to, things that will change their life, and, for generations potentially.
Yeah, absolutely. Is there any shout out to the podcast or any places that you would also like to have people just check out in general?
Yeah, if you ever want to check us out, obviously our website, aspenfunds.us, like United States. There's a wealth of information on there. You can see more on our track record, who we are, learn about our history, do as you please. But yeah, definitely check us out on our Invest Like a Billionaire podcast that's hosted by Ben Frazier, Bob Frazier. Those are two of our partners. So Bob being one of our founding partners, Ben is kind of the second gen and our chief investment officer. So it's basically unlocking the strategies of the ultra wealthy, and so I think there's a lot of investment wisdom in there. You'll get to hear from kind of our high ups as well. And yeah, if anyone ever wants to connect, I'm happy to be a resource.
Awesome. Well, I appreciate you being here, Mike. Thank you so much.
Thanks, Steven. Appreciate you.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.